Hello. This is very, I have to just, let the cat out of the bag. It's very strange to be talking to you guys, not hearing my voice back at me.
Yeah, really.
It's very strange. But admittedly, I'm very, very excited about this panel. I think it's going to be really interesting. Diogo's already said that he's going to keep it spicy, and I'm holding you to that. For those of you who don't know, I'm Katherine Ross. I'm the senior editor of news at Blockworks, and I'm going to let my panelists introduce themselves.
Thank you. Thanks everyone for being here. Rob Hadick. I'm a general partner at a fund called Dragonfly. About $5 billion under management. Invest in and around the crypto space since 2018.
I'm Paul, founder of Plasma. We are a blockchain focused on stablecoins, and we recently launched and moving stablecoins across the globe.
Simon Taylor, author at FinTech Brain Food, the weekly newsletter focused on where FinTech meets the future. I also run a podcast called Tokenized, a weekly show dedicated to the institutional adoption of stablecoins and tokenized real-world assets, available wherever you get your podcasts now. And I also lead market dev for Tempo, an L1-focused payments chain incubated by Stripe and Paradigm.
I'm a subscriber of FinTech Brain Food, so one of us is here in the audience. I'm also a general partner at Ahan Ventures, which is a venture fund focused on digital assets. I'm the chairman of the Near Foundation, and I'm also the co-founder and executive chairman of a company called Anchorage Digital.
Thank you, guys. So I think it's important before we really get into the meat of this conversation, which is discussing like the future of stablecoins and what they've done. But I think we should start by looking back briefly and just looking at what happened on Friday. And the reason that I think it's important is because it was kind of a test case for a lot of crypto, and stablecoins, I would say, we can argue about this, but I would say that they really passed the test. And I'm curious to get your thoughts on, and Rob, I kind of want to start with you because I know that you're going to keep it real with me, but I'm curious to get your thoughts on what happened Friday, what are the takeaways in the stablecoin lens?
Yeah, broadly, for those in the audience who don't know, and I'm guessing maybe most people do, we had kind of a significant downturn in price action on Friday following, I guess, some tweets around tariffs with China. In crypto specifically, like relative to traditional markets, obviously we had something around $30 billion worth of like liquidations that happened across all of the exchanges, and both on-chain and off-chain. Some of the tokens, especially the alt tokens, hit we're down 80% at one point in terms of their drawdown across different venues. I think, in the stablecoin specifically, if I were to, kind of focus on that, I think one thing that this probably did highlight was there is like kind of market structure or microstructure issues that we still have in crypto, right? So clearly with stablecoins being used as collateral across a bunch of different venues, there's risk involved, right? Because if you're going to have a mass amount of liquidations, people need to be kind of like forced sellers, or they need to of that collateral being stablecoins. If they're forced sellers, theoretically, there is a world in which like there's a supply-demand imbalance, and you could see like depegging, you could see people having a flight to quality, et cetera. I think one of the things that highlighted to me is that stablecoins continue to be mostly a liability, right? Which is that your liability on whoever the underwriter is or whoever the counterparty is that is issuing that stablecoin, right? And so one of the really interesting things that you saw was that across different venues, there's different prices, right? And so Tether actually was the only one during that period of time that was trading above $1 across a bunch of different venues. Now, the other stablecoins were in some form trading below $1, whether that was a few bips or whether that was, call it multiple points. And what does that tell you? That tells you that people are probably actually moving from whatever they hold as collateral today into Tether specifically, right? There's more demand for Tether than there is for the other stablecoins. So I found that to be pretty interesting. I think there's a conversation to be had, and I'm happy to have it if people want to, around Athena and specifically around the USD stablecoin, which on Binance at one point hit 65 cents. On pretty much every other venue hit, I think Bybit hit 95 cents. On Curve, it was basically 3 to 5 bips off. But I think broadly what it tells you, or it continues to highlight, is just that stablecoins, in so much as we have somewhat unsophisticated and immature market structure in crypto, still do have to perform in stress environments as credit, right? And they do perform as credit, right? And so being able to be robust credit is actually still very important, and being able to think through like how we structure stablecoins for a future that is, more sophisticated and much bigger, I think is still a really important part about how we grow this ecosystem.
I want to point out something that is interesting, which is even in this topic, how refreshing is it that we have something and then we can actually talk about the market infrastructure and structure and modify it in real time. In fact, the particular event that happened around Binance and USD and the fact that they were using as a price oracle their own book, which ultimately what led to actually the price decrease and liquidations on their own exchange, that actually was set to change already. So we're 7 days away from them actually using oracles and using better market infrastructure for pricing. And yet this happened, a few days before. But even then, like the speed at which this evolves and the speed at which the community comes around and points to there's a weakness here on the microstructure, on the macrostructure of how we actually set these things up is truly refreshing, because in traditional finance, these things change in decades, and in crypto, they're going to change in weeks.
Well, consider how different that is to 2008, where the single biggest problem was nobody knew what was going on, and that caused a contagion and panic. Crypto Twitter had solved it in hours. And some of the breakdowns and some of the deep dives are just some world-class analysis that you got to say. And founders kind of coming out, and that spirit of transparency, I think, is really refreshing. And the amount of learning you can do just by paying attention to that space. I do think it sort of speaks to an interesting bug that stablecoins have as a topic, which is there's this broad category set of things we call stablecoins, but actually the credit risk of those things may vary. Some of them, like Athena, are more synthetic and derivative in their nature. Some of them are one-to-one backed. And then, there was, everybody will remember a few years ago, Terra Luna, that's way off on the risk spectrum. I do think we need to start thinking about our terminology and phrasing and framing so that people understand when they're using collateral, they're not necessarily always using the same things interchangeably. I imagine most of the traders in this case probably do understand some of that, but as somebody interested in how this thing really does take over all of TradFi, then we do need to get smart on that and tight on that.
Well, and I think the point here too is that like Binance actually does haircut USD separately than it does USDT and USDC, right? And so like the sophisticated actors know, I think to your point, okay, well, there's been this like crypto trend of like just taking like anything and like wrapping it and tokenizing it and then calling it a stablecoin, right? Then we have like things like USDAI, which is just like loans against data centers, like and you continue to have these things and that are stablecoins, but they're stablecoins backed by some sort of synthetic or endogenous type collateral. The terminology is, to your point, like I guess part of the confusion for a lot of people, and I think does create risk with regulators, creates risk with like traditional market participants. But all the sophisticated actors, the exchanges, like they know, like they know that these things are different. It's just about a lot of it's about education, I think.
Yeah, and so where I'm coming from is I spend a lot of time dealing with the opposite end of the curve, where MNCs are trying to adopt stablecoins and various regulators are wrestling with how on earth they make sense of this stuff, and then this happens. And so, yeah, that was kind of the direction of where I'm coming from. I appreciate everybody has their own risk management that's sophisticated.
I do think one interesting thing to point out is, the most recent real DPEG of a stablecoin was USDC during the kind of SVB banking crisis. Where
the bank was the problem.
It was uncertain if SVB would survive the weekend, basically. And USDC was trading at 80 cents, 85 cents across venues. And so I do think the unique risks associated with kind of certain, even deemed as specifically safe stablecoins, especially where they rely on fully kind of trad banking rails and they hold a lot of cash, which I think is in a kind of uniquely vulnerable position in comparison to US Treasuries, for example. I do think that is still, I don't think there's been a proper true post-mortem on basically how does market infrastructure kind of deal with that reality where you're still to a large extent, and I think in Europe specifically, Nika exacerbates that problem where you're forced to hold cash as backing, which just by design actually isn't all that great of a collateral. And so I actually do think a lot of things need to change on that.
But Joe, let me just say, structurally, one of the things that crypto has that is amazing is, while in traditional finance we're still debating when settlement happens and T+2, T+1, in crypto we have proof of reserves for a lot of these projects, even when the parties that you're relying on for counterparty risk are centralized parties, there's ways for you to actually prove on chain that the perps that are backing this, or your hedge, or the cash that exists on these banks actually is there. And right now, we're actually going from proof of reserves on a weekly basis to proof of reserves on a daily basis to hopefully proof of reserves as close to real time as possible, which is something that structurally traditional finance cannot give you. They cannot give you this type of structure. There's no credible, neutral platform on the internet that allows you to aggregate all of the pieces of the supply chain, financial supply chain that you're depending on for this particular product that you just bought, say a stablecoin or some RWA or some structured product, credit risk product or whatever. They cannot do this in real time, and we can in crypto, which is beautiful. Every day that goes by, the proof of reserves is getting to a point where we can actually judge risk more accurately.
So you do solve some solvency risk questions, but liquidity risk is interesting because you come to redeeming assets that are off-chain, and there's a timing mismatch there. Yes. That's kind of an interesting question. So I think Tony at Ubix has opinions on this. I just saw him in the crowd, but the ability to clear at par certain types of assets, I think, will become really, really crucial to kind of closing that liquidity gap if we do start to use this stuff for payments at scale in the kind of volumes that you would expect in a TradFi payment system today.
Yeah, but I think the one thing that we have to talk about, right, is that, and I guess this is kind of like the genesis of this conversation, is that these things shouldn't actually trade at par to each other, right? Like because they are credit. Right, and like they are credit with different counterparty risks. They're credit with different collateral. They're credit with different audits, different reserves. Right, so like USDT has a very different counterparty risk than USDC. Now, it's clear in crypto that people have decided, based on how they trade, that Tether actually has better credit than Circle, and there's a lot of reasons for why that might be true. But it is different credit. Right, and like that is structurally part of what is happening with stablecoins right now, is that they are liabilities. Right.
Fully understand that, but that's true in banking as well.
Sure, right.
But the dollar is honoured at par between different financial institutions with
because of Fed access, right? So that's different, right?
Indeed, but this is where I think you could, the 9 European banks, 10 global G7 banks, they're starting to think of like, well, actually, if we're going to have something that could do cross-border at par, what would that settlement asset be? The Bank of International Settlements, Project Agora. There's a lot of push to actually, could you solve some of that liquidity risk and solvency risk at scale on chain for all of TradFi? And I think the timing there is going to be like TradFi doing it's going to take forever. But I do think there's a path to the existing stablecoins getting to that clearing can help you get towards.
Yeah, but what's happening there implicitly is that you're substituting credit risk of the bank or the issuer for credit risk of the government, right? Like that's
or some other entity.
Yeah, but like in this case, the central bank, right? Yeah. So that's like somebody else is backstopping it, right? Yeah. So that's the question, right? If we expect everything to trade at par, then is it that we need to have a CBDC, right? Because otherwise, it probably shouldn't be trading at par.
But I mean, stablecoins don't trade at par.
They don't, right?
I think especially like as you
as
said,
of today, they trade like this.
Specifically on Friday, right? I mean, I think the market is like the most honest signal on how crypto markets kind of value different types of collateral is where does it actually trade in times of stress, when everyone's like, I need to get to safety, and like I need to be in like the cash that the tokenized cash on chain. I think the market like is yelling at you that USDT is like the most pristine collateral.
But consider who's in the market as well. I think that's an interesting question. Like, and consider the objectives of like taking payments globally. Like, I wonder if the traders that are in market today and what their opinion on what the best collateral is would be true in 5 years, 10 years, if there is more adoption of payments.
I think if you look at the data on that, I think it's even more glaring. I think on one hand, I mean, yes, the trading universe is very Western skewed, right? And so that's where Circle and USDC have a very strong foothold. And if you look at the data on like the stablecoins that are happening at scale now in Global South, in Southeast Asia, in South America, you have 80, 85% USDT dominance, depending on the data you look at. I mean, the Bank of International Settlements has this like very long study out on like what stablecoins actually get used in like true payments use cases.
Yes.
And the dominance of USDT is overwhelming in that. And I do think that is like a very durable distribution advantage. And that may change over time, and like there's no guarantee that that is kind of the same in 10 years. But I actually do think the split on the true payments in stablecoins that are happening right now, it's very lopsided towards USDT.
Yes. I just wonder, to your point, does that continue?
But Sam, one of the things is that if you go straight on chain and if you're trading directly on chain, you are taking counterparty risk of these, and you should be able to judge that these things are not trading at par. And in fact, some DeFi pools do trade them at par, which is maybe potentially part of the issue. But what's happening is that the private market is stepping in. Many of the financial institutions right now that are coming into stablecoins will interact not directly on chain, but through some provider that is willing to take on the risk of doing it at par. So there will be a bank, there will be a federal chartered bank that will take a deposit and will guarantee that the stablecoin that comes.
I can see where this was going.
Willing to underwrite it, because depending on how good you are, it becomes an actual product. It becomes a way to make money. If during a market downturn somebody's willing to sell you $1 for 95 cents, that you actually know for a fact because you have proof of reserves that is actually worth $1. I call that money. That's 5% that you can clip directly on that trade. So somebody will take on the risk, and it doesn't have to be that the world is everybody interacts on chain. It could be that these wrappers actually exist, and this becomes a product.
Good point.
So one thing that we've kind of circled about that I want to get a little bit more into the meat of is regulation. And I think that we're in an interesting space, especially in the United States, of where we really are starting to see stablecoin regulation come to a head. But there's still conversations happening. And Casey Wagner's been reporting for Blockworks that, the banks aren't really for stablecoin issuers having yield, and that's causing a whole other conversation. And I want to kind of dive into that with you guys, because I think that you will all bring interesting perspectives to it. So I guess my question for you is what if the banks are able to put a stop to yield being okay with stablecoin issuers, what happens next?
I think, by the way, the answer is we go further on the risk curve and crypto finds some other way of generating the yield. That is the only answer. And by the way, we're going to make this mistake multiple times until we learn. One of the original problems around the crypto ecosystem is that the regulators did not welcome the crypto companies into the fold. A lot of the issues and the companies that went bankrupt, that were horrible for crypto in its reputation, only were able to operate that way because they weren't regulated. So I can guarantee you that if a lot of the companies that went bankrupt were within the regulatory regime and were within the regulation of the OCC or the new IDFS or whomever in the United States, they would not have gone bankrupt, and nothing as egregiously bad as it happened would have happened. And this is the same thing. If you push the yield out from the regulatory perimeter and the regime of the Genius Act, then all of a sudden you're going to get some derivative, you're going to get some wrapping, you're going to get some creative way. Crypto people are very creative. You're going to find some creative way of doing it. Wouldn't it be great for it to be a creative way within the rules, and so that everybody's aware of what can be done and what can't be done? So I think that would be making a mistake twice.
When you say the bank lobby, not all bank lobbies are created equally. The American Bankers Association hasn't said much. It's the ICBA who's lobbying against this, who are the Community Bankers Association, so the small banks. And there was a report, I think, a stat originally put together by Goldman that was quoted by the US Treasury that anticipated stablecoins would drain $6.6 trillion of deposits from financial institutions. Now, if you're the board of a bank, it is your fiduciary obligation to fight against whatever is going to create deposit flight. Like, that is existential, because if you don't have deposits, then you don't have funding for your balance sheet to be able to lend, and 60 to 80% of lending in Main Street United States comes from those community banks to SMBs. That is a lending source that could potentially be threatened. So you have to consider why they're making the argument they are before you can deconstruct it. I think one of the deconstructions is fundamentally that, which is, well, you'll just make the problem worse. But that doesn't solve the problem of the community banker. I actually, being from a fintech background, think that the last big financial services legislation in the United States, the Dodd-Frank Act, had a really interesting quote called the Durbin Amendment. If you're not familiar with the Durbin Amendment, it essentially capped the swipe fees on debit cards for all but the very smallest banks. And the idea was that when you walk into a store and swipe with your big bank card, that big bank card wouldn't reward the big bank nearly as much as it would the small one, so the smaller bank has a right to win and survive. But what actually happened is Chime and Robinhood and Cash App and all of these giant brands go out and they partner with these incredibly small little banks that most people have never heard of, Coastal Community Bank, Lead Bank, who go on to become actually not just supporting the fintech industry in the United States, but supporting most of the crypto industry and stablecoin issuers as well. And they go on to have some of the best return on equity, return on assets of any financial institution in the United States. So there's this interesting model where it can be an opportunity for financial institutions, and that's the argument that's, like, it's one thing to say that it's a stick, like, oh, well, we'll just make the problem worse, but where's the carrot for the financial institutions and the banks? Because if we want to bring all of the institutional liquidity on chain, then we have to welcome those institutions themselves on chain, at least a subset of them.
Yeah, I get the point. I also just think the community banks are like in their last gasp of like a dying breath, right? So like
Most are.
Yeah, the community banks have been dying for a while, right? Like we continue to do things to try to save them. This is a very, I think, U.S. specific point. Maybe I don't understand the European banking market as well, but we've been trying to save them for a while, and it continues to be that people don't actually want to deal with their local banks. The economics of a local bank are really tough. People are engaging, primarily with their financial services providers digitally. The digital offerings of community banks are, much worse than they are of larger banks, and typically because of funding, right? You get better rates now from J.P. Morgan or whoever else, right? And so the community banks continue to be very concerned about what their future looks like at a time when we are just probably going to have a commoditization of like what they offer, right? And so they won't be able to have the right economics. And then you have better unit economics at the large banks and better unit economics at the tech forward startups, right? And so those who aren't tech forward in the middle are probably going to die, right? And we can continue to try to save them for as long as possible. And like, as they...
I just think they need a right to play.
Yeah,
and that doesn't have to be a legislative thing. I think it's more of a narrative and an argument, which is there's an opportunity for you.
Well, if you talk to, and actually I'll reference someone else's stablecoin space, if you talk to Chad Cascarella at Paxos, right, he'll tell you that he thinks community banks, their only way to survive is to adopt stablecoins, right? And he'll tell you that, like, he's on the path of trying to get every single one of them to digitize their business using stablecoins and tokenized assets, because that's how they can control their economics. That's how they get better uptake on their ROE and their return on assets. That's how they could keep a better user experience for their end customer, and that's how they'll survive. And I think that's like a reasonable point. I just don't think they'll do it, right?
Most won't.
I think that's also like that has materially changed in the last probably year or two, right? I mean, the SEC killed Silvergate completely, and I mean, this is like not a conspiracy theory, but like that's an objective fact.
Yeah.
And they killed them for servicing a lot of the very large crypto players, and like the U.S. government, specifically the SEC, just not being comfortable with that. And so I think also this whole every bank just has to shift into stablecoins, that was suicidal 2 years ago.
Yeah.
And so like I think there just hasn't been a lot of time for anyone to like really lean into that strategy.
And adjust your mental model as well.
I think that there's some banks that have done that extremely well. I mean, Lead Bank, Cross River Bank, like there is these entities that are like fast moving and who now service a lot of the stablecoin ecosystem. But banks haven't had a lot of time to adjust to the new reality of, oh, I won't get killed if I interact with crypto in any capacity.
So the UK market's very different. I just did want to bring it to the UK. I saw the Lord Holmes on stage earlier and had a good chat with him on the way out. And I know they had the Right Honourable Nigel Farage here earlier. And I do think that the UK has an interesting opportunity. It's got a very concentrated banking market, as most of you guys know. And that sort of means that the big banks aren't going to move quickly. They're all as big and as slow as each other. There isn't that sort of lead bank, customers bank equivalent in the UK, so it's very difficult to get them to do anything meaningful or to have the entrepreneurial ecosystem in quite the same way. And there isn't the lobbying impetus in the UK in quite the same way there is in the US, despite the fact that it is, outside of New York, biggest global financial center, and yet it now I think eyes Singapore and the UAE and sees like global competitors really starting to emerge, and there's just a slowness. I hope that becomes a last mover advantage, not like a complete slide into irrelevance. My fear is we've just got to get on with it. We really do have to get something out there quickly. But from conversations I've had, there are some very, very thoughtful policy options that you could have for functional equivalence in a way that MiCA can't. Like, MiCA is just a mess. Now, it was designed as market structure regulation, not payments regulation, but that won't get cleaned up until PSD3, which might be 2030, 2032, who knows. The UK has a really interesting opportunity to do a Eurodollar 2.0, to have that moment in which it's plays to its strengths and becomes the best clearing hub for stablecoins in the world. That would be really, really interesting. I think the ambition is in this room of people that can do it. I just hope that that's enabled and unlocked.
So let's talk about the UK too, because you kind of touched on this, but I want to see if I can press it a little further, which is, aren't you afraid then, if the banks are not going to be capitalizing on stablecoins and the energy around stablecoins, that it just gets left behind? Like the UK just gets left in the dust here?
Yes. The short answer is yes, and I think the statements coming out of the Bank of England have shifted. They were still very much warning the big banks off doing too much in the space, and I think there's a lot of global financial crisis scar tissue coming out in a lot of those statements, and around systemic insolvency risk. It sort of looks not dissimilar to the US a while ago, but it's interesting how different the Treasury sounds are to the bank, and where that nets out and starts to normalize over the next 6 to 12 months, especially with Revolut potentially looking to IPO in the not too distant future. There are a few things that this country sorely needs some tax revenues and needs an IPO story. It has one ready-made in Revolut, and I can't think of many fintechs in the world that are more aggressively leaning into crypto as a part of its long-term growth strategy. And so whether, I note with interest that the Right Honourable Rachel Reeves was at the launch of the Revolut HQ a couple of weeks ago in Canary Wharf. I wonder if there are these sort of things working their way through behind the scenes that would enable that. Again, I think that window and that of opportunity is closing. Got about 6 months to get this right. And if not, then yeah, you might as well call it game over.
I'm actually curious. What is I guess the most pointed way to ask this question is, what is UK's right to win a world where 99.9% of stables are dollar denominated, and it's pretty clear that anything that they do is one further step, one added risk layer than whatever.
I think
US
it's
bank
quite
does.
clear. It's being the bridge to on-chain FX. If you have large regulated financial institutions that can enter token markets and can clear stablecoins of multiple currencies and can do that against fiat, then where is the global financial center for clearing? For US dollar, euro, and GBP, historically it has actually been London that's been the major FX center.
So, but this implies a world where stablecoins are not 99% dollars, correct?
Yeah, I think so, because
Which is not the world we're living in right now, correct?
No, but it's not, but it's also inevitable that if we are going to get to last mile solving and to global corporate treasury and to being able to pay suppliers in local markets, you need FX. So FX becomes the next logical bottleneck in the stablecoin market. And who has a right to win in that? I would argue it's London.
Yeah, it's kind of interesting that it hasn't happened yet, that we've all been waiting for it to happen.
Yeah, because there's no demand for on-chain GBP in the crypto markets. But there is demand for it as a payments instrument in the real world, as an FX instrument. I think that's fairly.
The problem here, like the story around like stablecoin FX is, and okay, well, it's 99% USD, has been entirely around like what do people actually hold, right? There's no demand to hold GBP on chain. There's no demand to hold a euro on chain. There's no demand to hold, the krona on chain. There's no demand to hold anything else on chain, right? Because people see the U.S. dollar as, the thing that they want to hold. It is the gold standard, right?
For global south, yeah. For treasury managers, yeah. But for the real economy, no. And
it is empirically true that there is no demand today on chain to hold any other currency. Now, your point around is there demand to hold GBP if you're a GBP denominated business or bank? Of course, right? Like you don't want to take that FX risk. Or do we want to hold euro if we're a euro denominated business? Absolutely, right? 68% of global FX is done in US dollars, right? 99% of stablecoins is currently US dollars. Is stablecoins going to meet somewhere between those two? Like, yeah, they have to, right? Like if we're going to have any real payments. The question becomes is, and I guess I'm going to give a point of view. It's not just a question, but like I think we're broadly in a currency cold war at the moment, right? Mostly between China and the U.S., right? With the UK kind of like figuring out like where the fuck it's supposed to play, right? And like the how does that evolve over time? I think it's pretty clear that like if you're not a G20, like your currency is probably going to get devalued, and it's going to continue to get devalued. Like there's going to be probably a just sort of I guess a culmination of a lot of smaller countries realizing that like they just do not have the ability at their Federal Reserve or their federal bank to control their monetary policy in the way they want to, with the globalization that has happened and with the currency's continued proliferation for other countries, right? And so then it becomes, does the UK, does the EU want to proliferate their currency in the same way that the U.S. government does, or that the Chinese government does, right? And it's not clear to me that like the ambition is there, or even frankly the capability is there in the same way. And so like, I think like if we're talking about on-chain FX, like I do think we're certainly going to get more. It's not going to be 99%, but it's not clear to me that the GBP is the next one to come.
I agree with you on ambition and capability, but also London as an FX clearing center, whenever that does emerge, I still think has a right to win.
One thing that we talked about a bit when we were prepping for this panel was the way in which we've seen the industry really enjoy the success of stablecoins and how this has now led to institutions really coming in. And because we've got a very institutional audience, I want to talk a little bit about what you guys think is the next step for stablecoins. What keeps the momentum going? And Rob, I'm going to just toss it to you first.
I do actually think it's treasury management to like actually get like pull back a little bit, but no, I mean we see it in the U.S., right? There's a bunch of Fortune 500s who are actively out with like RFPs using name your consulting firm to like try to figure out how to plug in plug in stablecoins into like their global operations, right? I think that's like very clearly like a next step in evolution where like if you are Coca-Cola and 80% of your water comes from Western Africa, like you do not want to park money at some bank in Western Africa. You want to continue to park as much money as possible at JP Morgan, but you need to pay your suppliers, right? It's, you can send a wire through JP Morgan, which today still loses your wire not half the time, but some percentage of the time, right? And still today, like, has, 7 to 14 day settlement into Western Africa. Correspondent banking system doesn't serve them well. And so, it's clearly a better product for that, right? If you can get intraday and real-time yield generation and not have to, manage your yield product versus your cash product, in the same way, and you can get, better, you can essentially like clip, more bips on top of that. Like that's a better product, right? So it's pretty clear to me that like tokenized assets are better. And then when we start thinking about, okay, well, are there going to be tokenized equities? Can we trade 24/7? Is there better collateral management doing that? And then if I have, more tokenized assets, more tokenized stablecoins, et cetera, to be able to interact with those other tokenized assets, like these things are needed, right? It's like stablecoins are infrastructure needed for the rest of a tokenized economy if we are going to move in that direction, right? And so I think that's a big one. I do think it is to the point around the GBP and the euros. I think it is. Mika is going to get in the way of that for a lot of the European companies. I expect I don't know what will happen in the UK, but I'm not bullish. But I will
broadly
say
broadly bearish.
But like in the US and the financial hubs in Asia, like we're very clear, and in Latin America, we're very clearly seeing people, I think, work towards that future.
I agree. I mean, I think it's easy to forget how incredibly nascent of an ecosystem kind of stablecoins are. They basically didn't exist 4 or 5 years ago. And so like this entire growth is kind of a phenomenon of the last, basically since 2020 is really when stablecoins kind of meaningfully took off. And I think a lot of the kind of infrastructure and processes are highly, highly, highly nascent and will look wildly different in probably a few short years. And I do think that like it's tough to underestimate how incredibly valuable stablecoins are as a kind of export dollar product. Where I think yes, it's tokenized kind of collateral across venues, and you can like easily move money, but really you do have so much global demand for USD that just isn't being met in the traditional banking system. And so really on the payment side, it's this really interesting juxtaposition really where stablecoins really have two use cases, which on one hand is kind of the very crypto native trading, collateral, moving money between venues. And then it's like the non-US, non-EU kind of retail and consumer access to USD payments. I think those are really the two things. I think that changes, and you probably do have kind of, especially on the payment side, kind of more things coming. But that is, I think, an accurate description of where stablecoins are as a market right now. And I don't think anyone has productized the payments particularly well, but it's still, and like I spend so much, like you go to El Salvador and like there's a small kiosk and you can pay with USDT on Tron. You like get out your Binance and Trust Wallet and oh my God, do I have energy for the gas, and like, the whole thing like obviously won't look like this in 2 years, 3 years. It's just too valuable to kind of just be this kind of shoehorned system of randomness, basically, that is just kind of emerged out of the demand. And I actually think that is kind of the biggest opportunity and biggest change, is really kind of productizing the stablecoin payments well, especially on the kind of consumer-facing, non-US, non-Europe, kind of for that audience. I think that is where I think incredibly valuable companies are going to be built.
I think there's this interesting sort of G20 down market that I think Tether, historically Tron, now Plasma, are uniquely positioned. Are uniquely positioned to be the dollar for everybody else. A global corporate treasurer was using the dollar quite historically to move it around, but they were using the correspondent banking system. A stablecoin is a better product to do that, especially if you are going local to local. So if I'm going from India to Brazil, I don't necessarily need to go through New York in order to enable that. And so that sort of like those local routes, those local corridors are as valuable to a multinational corporate as they are to kind of somebody who lives there and has a local corner shop. And I think that seems, to Rob's point, to be where the real action is. The question is, how old is that corporate? So if you are a 100-year-old company, you really want your banks to do that for you. You want them, you've got 10 different banks, you have SFTP uploads from your ERP system going to all of those banks, you're trying to manage all of that complexity. Bank, please solve it and please continue to lend to me. If you are Nubank or Revolut and you have 70 million, 100 million customers, then you are thinking very differently about what stablecoins enable you to do. And I think that's kind of the sweet spot here of the next stage of stablecoins, is stablecoins for that growth business. And it can be a fintech or a non-fintech company, but then also what that enables. Think about what Coinbase has today as what your neobank will have tomorrow and what your bank will do in 10 years' time. Coinbase offering yield to consumers via the partnership with Morpho is something that SocGen also offers, right? That's something that blew my mind, that SocGen's SG Forge has a partnership with Morpho. So these on-chain credit markets become available when you've got stablecoins as a base layer. So where I think that goes is the G20 payments infrastructure will start to come soon.
I think one thing we're talking about treasury management, which is an institutional type of what's next. I think on the retail side, it's kind of interesting to see these parallels, but the second biggest reason why people hold stablecoins in the global south is because they want access to the dollar and they don't want to be exposed to their local currency. Like Rob mentioned, they see the dollar as the gold standard for where to park their dollars. But if you look at it in another way, stablecoins are essentially tokenized dollars. And the next thing after you have enough money to live and stashed away is you start looking for investment. And that's where we're talking about RWAs. I think it's absolutely true, the fact that stablecoins are the way that you get money on chain, but then you're going to keep the money on chain, and you now want access to dollars because you don't have it, but next you're going to want access to Tesla and S&P 500. And that is 3 orders of 4 orders of magnitude larger than, M1 and M2 supply and just the dollar denominated demand. And so from a retail perspective, what's next is they come through stablecoins, they get the stablecoins on chain, now they access the capital markets and the investments, and I think the metric that we need to start tracking to see if this transition is happening successfully really is the number of stablecoin dollars that never transition back to traditional fiat and that stay on chain. So that's the metric to look out for.
And he did it right on time. That's our panel. Thank you guys so much for joining us. I thought this was a great discussion, so I appreciate it.
Well done, gents. Thank you.